In the news this week, central banks say they are not finished buying gold. High mortgage rates keep frustrating the housing market, and retail sales point to a possible economic slowdown. Let's dive in because there's more to look at. Before we begin, remember to like this video and subscribe for more economic updates. Topping the news this week, according to the results of the 2024 Central Bank Gold Reserve Survey released on Tuesday by the World Gold Council, it appears that central banks worldwide have every intention of continuing to buy gold through at least the near term. Among the survey's biggest revelations is that more than 4 in 5 respondents said they expect gold reserves among central banks to increase over the coming year. Additionally, 62% of central banks, including 56% of central banks representing advanced economies, expect the dollar's share of global reserves to fall over the next 5 years. Also this week, a couple of widely followed metrics seem to underscore the disruptive impact of higher interest rates on the housing market. On Wednesday, the National Association of Home Builders reported that its housing market index fell 2 points in June to a measure of 43, its lowest level since last December. The reading was also 2 points lower than the consensus estimate of economists. Notably, all 3 component measures of the index, current sales conditions, sales expectations for the next 6 months, and prospective buyer traffic, fell below the key threshold of 50 for the first time since the beginning of the year. This means that, in every category, more builders view market conditions as poor rather than good. In a statement, NAHB Chairman Carl Harris said that high interest rates are hamstringing both prospective buyers and builders who are dealing with higher rates for construction and development loans. Unsurprisingly, the impact of higher rates also appeared to be reflected in the government's data for housing starts in May. On Thursday, the Census Bureau reported that construction of new homes fell 5.5% last month to a seasonally adjusted annual rate of 1.28 million, the lowest level in 4 years. The same report also revealed that building permits assigned to future projects fell nearly 4% on the month to a rate of 1.39 million. In other news this week, the Census Bureau also reported that retail sales barely ticked up in May, another sign that a possible slowdown in the economy could be brewing. According to the numbers, sales at U.S. retailers increased just 0.1 percentage point last month, short of the 0.2 increase projected by economists. What's more, the report also reflected a downward revision to the April sales numbers. Originally, the Census Bureau said that sales were unchanged from March, but now the agency says that sales declined 0.2 point in April. Analysts suggest the report is coming at a good time for the Federal Reserve that may be looking for reasons to justify an interest rate cut as soon as September. Finally, the Conference Board reported on Friday that its leading economic index fell once again last month, sinking by a larger than expected 0.5 point to a reading of 101.2. Economists had forecast a more modest decline by 0.3 point. This marks the 25th time in the previous 26 months that the LEI has fallen. And while the Conference Board did abandon its long-standing recession projection back in February, it is expecting real GDP growth to come in below 1% annualized over the second and third quarters. That's all for now. Make sure to join us on Monday as we keep reporting what's going on in the economy. This is Devlin Steele for Augusta Precious Metals signing out.